OG John XX. Before anything else, how are you holding up? And I mean that as a real question, not a courtesy. Because if you have been watching this market with any level of attention over the last 10 months, you already know something is happening. Something that most people cannot name yet, but can feel. The tension is building, the data is accumulating, and the noise from the mainstream is getting louder in almost perfect proportion to how wrong it keeps being. Drop a comment right now. Tell me where you are mentally with silver, because this community exists for one reason, so that when the moment finally arrives, none of you are standing on the outside of it wondering how you missed it. I went through every comment from the last video, every single one. And what struck me was not the questions about price targets or the debates about timing. It was how many of you are genuinely trying to understand the structure underneath this market, not just write a number, understand it. That distinction matters more than most people realize, and if that describes you, what I am about to lay out is going to land differently than anything you have heard on this topic before. So let us get into it. Because the data from this week does not allow us to wait. Silver has now printed 10 consecutive green monthly candles. 10. That is not a streak, that is a record. No other period in the documented history of the silver market has produced 10 unbroken monthly closes in positive territory. Not during the Hunt Brothers squeeze in 1980, not during the explosive 2010 to 2011 run that took silver from the teens to nearly $50. Not once. This is the first time this sequence has ever appeared on the monthly chart, and the mainstream financial press has not run a single headline about it. Think about what that tells you. A once-in-history technical event is unfolding in real time in one of the most globally significant commodity markets on Earth, and the outlets that claim to cover markets professionally are completely silent. That silence is not an accident. It is a structural feature of how information flows, and understanding that flow is the entire difference between being early and being late. Now here is what makes this streak remarkable beyond the raw number. It did not happen in a calm, favorable environment. It happened through genuine adversity. Silver was sold aggressively during this stretch. There were weeks where coordinated pressure came into the paper market with the clear intention of breaking the bid. Managed money positioning collapsed. Headlines called the rally exhausted. And still, every single month, the market closed green. When a market absorbs that level of selling pressure and refuses to give up a monthly close, it is not stubbornness. It is the expression of demand so deep and so structural that supply simply cannot overwhelm it at the monthly resolution. That is the signal most people are not trained to read. On the fundamental side, the picture behind this streak is not speculative. It is industrial. Global silver demand for industrial applications hit 680 million ounces last year, a record. Solar panel production alone consumed 232 million ounces, up nearly 64% from 2 years prior. Electric vehicle production, 5G infrastructure, military electronics, advanced semiconductor manufacturing. Every one of those sectors requires silver, and not one of them has a substitution pathway that works at scale. The periodic table does not negotiate. Silver is the most electrically conductive element that exists, and the world's most important growth industries have made it structurally indispensable. That is not an opinion. That is physics applied to economics. Meanwhile, primary silver mine supply has been effectively flat for a decade. The large, high-grade deposits that drove the production surges of the early 2000s have been depleted. New discoveries are smaller, lower grade, deeper, and more expensive to bring into production. The average lead time from discovery to first production in a major silver mining jurisdiction is now between 10 and 16 years. The supply response to higher prices that commodity bears always point to as the natural ceiling on any rally is not coming on any time frame that matters to what is building right now. You cannot drill your way out of a structural deficit in a single price cycle. Here is the layer that most people following silver are still not connecting. The same private institutions that have been deploying capital into AI infrastructure, data centers, computing build-outs, the physical backbone of the artificial intelligence economy, are also among the largest indirect consumers of the silver supply chain. Not through direct purchases, through the semiconductor and electronics manufacturers they are financing. As AI capex accelerates, industrial silver demand does not grow linearly, it compounds. And the supply structure sitting underneath that compounding demand has not added meaningful new capacity in a decade. The math on that collision is not subtle once you see it clearly. Now I want to address something directly because the comments have made clear this community is ready to hear it. Someone wrote that 10 green months means the easy money is already gone. And honestly, that instinct is understandable. It is also exactly what the structure wants you to believe at this moment. The entire function of the accumulated selling pressure during this streak was to produce that feeling, to make accumulation feel like exhaustion, to make strength feel like a top. The managed money long positioning in COMEX silver futures is still sitting near a 20-year low. The speculative community that historically amplifies silver moves by 300% and 400% above the fundamental baseline has not arrived. A market that just printed a historic 10-month green streak is doing it without the momentum chasers. That is not a sign that the move is over. That is the definition of a move that has not yet started in the way that gets remembered. Here is what actually works when you are navigating an environment like this one. Fundamentals tell you what. Technicals tell you when. And right now, both are speaking simultaneously in a way they rarely do. The monthly structure is unbroken. The weekly structure is holding key demand zones that were established during the most intense selling weeks of this streak. The $28.50 level has acted as structural support through 5 separate tests. Every time the paper market pushed silver through that zone intraday, the physical buyers absorbed it and closed it back above by end of week. That is not retail. That is institutional accumulation, expressing itself in the one place it cannot hide, the closing price. Now let me give you the honest resistance case, because intellectual honesty is what separates this channel from the metals hype ecosystem you have probably already scrolled past. Silver at these levels with a historic streak behind it is technically extended on shorter timeframes. A sharp pullback of 10 to 15% would be structurally normal and would not break a single element of the fundamental thesis. In fact, it would be the kind of reset that historically precedes the largest legs of commodity bull markets. Jim Rogers documented this pattern extensively, violent corrections shaking out weak hands in the middle of structural moves that ultimately carried multiples higher. The structure surviving is not the same as the structure being immune to pain. Conviction without that understanding is just hope with a chart attached. But here is the counter. Silver miners are pricing in a future that spot silver has not caught up to yet. The equities are moving. The options market is seeing unusual positioning and strikes that only make sense if institutional participants are modeling spot silver significantly above current levels over the next 12 to 18 months. The physical premiums at major dealers have not compressed the way they normally do when a rally is speculative in nature. Physical demand is not retreating. It is the foundation the paper price is resting on, and that foundation is expanding. Taken together, this is what the data is actually saying. A once-in-history 10-month green streak built on record industrial demand, structurally constrained supply, historically low speculative participation, and a physical market that has refused to break under coordinated selling pressure. These are not separate observations. They are the convergence of every condition that has preceded the most significant silver moves in modern market history, arriving simultaneously, in real time, while most of the mainstream audience is still looking somewhere else. The ones who understand what they are looking at will not need permission to have conviction. The ones who are still building that understanding, that is exactly why this channel exists. Invest with logic, not hype. OG John XX, out and about.